right. Thanks for joining us on an episode of Ask the CFP. On Ask the CFP, what we do is we answer real life questions for individuals that have questions around their finances and want to make sure that everything is in tip top shape. So today we have some questions around business as well as personal finances. And just as a reminder for anyone who's joining us for the first time, Ask the CFP is a questionnaire type of series where individuals ask real life questions and we answer those questions as CFPs, Certified Financial Planners. And today it's myself. My name is Kelsey Wilson. And I have Renee Cohen with me, who is going to be answering questions. So to kind of jump things off and start things off, I do have some business questions for you, Renee.
Okay.
So the first question that I have is around consulting. So for individuals who are doing consulting, whether it's their full-time job, part-time job, one question I got is, do they need to set up an LLC? Is that something that's required? And just what are your thoughts about setting up an LLC for someone who's doing consulting?
Yeah, I think this is it's a common question and that that a lot of people, it's always sitting on someone's mind because if you're like, hey, I want to start a business, whether it's a side business or transition side business into a full-time business, you Google it and it's like, oh, start a, LLC or an S-Corp. And there's a lot of maybe misconceptions and confusion around those words. And I think it's a lot of people just need to simplify what do they really need. So first and foremost, what an LLC is really the limited liability company. So it's really separating you from your business. So if any liability, so if someone was to sue you for any reason, they're not also able to take your personal assets. So obviously setting up an LLC in any way is important, especially as you have more and more assets and want to separate your personal from the business, which I always think is a smart idea. But I think a lot of people don't realize that the LLC is really just the umbrella, and there's 4 different ways that it can be taxed. So that structure is more important than anything else as you are either starting your business again as a side business or transitioning into full time. If you're one person and you are doing consulting, and let's just say you're in marketing and you are also doing some marketing consulting projects on the side, then typically, yes, it's good to have the LLC, but that is what's considered a sole proprietor, where you're passing through the income, anything that you're making from your consulting business could go into any of your bank accounts, frankly, and it's considered income. You're going to be taxed on those dollars. It's the most simple way and the most uncomplicated way, right, is to kind of start the LLC or to be part of the LLC. Even with that, though, just for simplicity and maybe just peace of mind, is that you still want to have separate business accounts and personal accounts, just so you're not commingling business expenses and business income with personal expenses. Although, again, you can kind of put it all in the same pot and you have to separate it out for the IRS. They are going to still tax you on those dollars. So I always advise people when you're starting out is you don't have to complicate anything. Yes, get the LLC, but also just start as a sole proprietor and see, like, is this the path that you want to go down?
Yeah, for sure. I feel like people get confused and just make it a lot more complex. Like I can't start until I have the LLC, but
Yeah.
like you were saying, like you don't actually need it. It's helpful, it's good to have, but you don't actually need it.
Yeah.
So yeah, that's some really good insight.
But then I think when you're Googling, like, okay, the structure, the second way that you can structure the business is the S Corp. And my belief is that you don't really need to have the S Corp until you're actually making a certain amount of money in your business. If you're doing consulting business on the side and maybe bringing in 5, 10, 15, $20,000, like you don't really need the S Corp. The S Corp now splits you into 2 people. Renee the employee and Renee the employer. And Renee the employer has to pay Renee the employee a reasonable wage. So there comes along is payroll, right? Payroll tax, having a payroll service, the fees that are associated with that. Because if you don't pay your employee anything, then yes, the employer, you're still being taxed. And yes, you are saving money on the business income by not having to pay payroll tax. But how many times do you see this, is that I have had so many times people have come to me and it's like, well, I need to lower my taxable income, and they want to put money on the personal side in their retirement account, but because they didn't pay themselves anything, the IRS does not recognize you having as any wages. Therefore, you can't put money into a Roth IRA. You can't put money into a traditional IRA or a SEP IRA. So you can't put any money in the retirement account because you don't have any W-2 income.
For sure, yeah.
People set up the S-Corp and then they don't pay themselves anything.
Yeah, for sure. I see that all the time. And one, you can't really do that from a long-term standpoint legally. Eventually, it's going to catch up to them by not doing that. And then, yeah, the second thing is, yeah, you have to make sure all that stuff is structured. You make sure that you're paying yourself a reasonable salary. You're tracking all those different things. So, yeah, I see it all the time where people try to do it to pretty much eliminate taxes when it kind of puts them in a situation where there's a lot of stuff that they just can't do anymore
Yep.
on that end. And then also when you were saying like the LLC and the S-Corp, I also see that like a lot on social media as well, where individuals will say like, should I be doing an LLC or should I be doing an S-Corp?
You're like, it's the
When
same.
really like they're really the same thing
Yeah.
exactly. So that's another kind of piece where we were talking about someone who's doing consulting. It can just be very complex if you're like, okay, I need to be doing an LLC or S corp, and you're googling stuff and you're looking online.
Yep.
When really the LLC is the S corp, it's the same exact thing. That S corp is just how the
Right.
tax
Yeah.
structure is, and the LLC is the entities. So yeah, I feel like it. I see a lot where people aren't paying themselves, or they're just doing things based upon what they see online,
Nine.
and
Yeah.
it can kind of be a little scary if you're not on top of it all.
Yeah, I see that, I see it all the time as well. And I have a client now who just started a partnership. So that is also another way that the LLC can be taxed, is that if the two of us are in partnership, and that operates in the same way as the sole proprietor, where it's passed through, considered what's called pass through income. And that's also a simple way, especially if you're, starting out the business as a partnership. I mean, obviously, if it's 50-50, it's pretty simple, but I think ultimately, yeah, you always want to have the umbrella over you. Like you always want to have the LLC, but I think a lot of times people get really complicated with the way that they think that they have to structure the business right away. And I always like to guide people to do more simple. And then as you're making income, then kind of restructure the business.
For sure. For sure. Well, I guess a follow-up question that I kind of have to that is for someone who is doing things simple and consulting and things of that nature, at what point do you think that they should kind of get into something a little bit more complex or have something that's S corp structure and paying themselves a salary? I get that question a lot too, which is when should I be doing that?
Yeah. I mean, obviously, like in anything that we do, there's no like perfect answer. I think it depends on someone's business. I mean, $100,000 is usually my benchmark to say like we're going to look at like what kind of vehicles make the most sense for you to really optimize, right? Like when you're a sole proprietor, again, LLC, sole proprietor, I usually start with the retirement vehicle to help the business owner, lower taxable income. In today's moment is the SEP IRA or a simple IRA, most likely the SEP, because you can put a little bit more money, you could put a lot more money than the traditional IRA. But if they're not maxing out their SEP and they have no desire either to bring in new people, then there, like, that's usually when I'm like, we can kind of, once we're kind of getting to a place where we're maxing out that SEP IRA, and we're going to want different strategies, and they're making somewhere between $100,000 to $150,000, is usually my area where like the next step is to now transition into the S corp. Um, Obviously, there's going to be situations where that they may be a little bit different, but that's usually my benchmark to say that the S corp makes more sense, because now you want to pay yourself. We probably want to transition that retirement vehicle into from a SEP IRA into a solo 401k. And then the other time too is that if someone is bringing someone in on the business, if like, if they're starting to hire people, then even if their income is lower, then that's usually also the time where I'm transitioning into a SEP, S.
Makes sense. So for someone who is doing that, they're consulting. getting to that point, they're making $100,000 in their consulting business. Things are starting to go well. What should they be doing? What should they be preparing for? Let's just say they have a job and now they're actually going to be leaving their job
Getting that
completely.
done.
Yeah, what should they be preparing for, or what should they be doing financially to prepare themselves to leave that corporate job or to leave that job and go full time into their business?
I think, preparation is going to also look different for everyone else, but it's going to be the type of business that you are transitioning into. So if it's the consulting and that's really just leveraging your time, and time is obviously a very valuable asset, but if it's not, if there isn't a whole lot of overhead and it's really just like your intellectual capital that is what your business is, then I think is making sure that you have a runway, right? So I always like to see someone having somewhere between like 6 to 12 months of a runway, because I think for both of us and starting businesses, we know that even if you have on paper all of the expenses and things go perfectly, there's always the outliers. There's always expenses that you either didn't anticipate, or things, take a little bit longer. So there's the cost around it. That's maybe you're like, I thought I needed this level, but now I need this level of service. So I always like to see that you have understand what your runway needs to be, because you want to start a business. There's nothing worse than starting a business and feeling like you have to get clients immediately.
Mhm. For sure.
you
For
know
sure. That could be very stressful.
It's very stressful. Like, you should not go into any coaching, consulting, business and saying like, okay, yeah, I'm turning the lights on. Yes, I have a website. I have, way for someone to reach out to me. I have social media, whatever it may be, and I can start to bring in clients. I think that could be bare bones, but you shouldn't go into that coaching business or consulting business saying that if I don't get a client this month, then I got to go back to my job.
Sure. For sure.
So I always like to see a runway. And understand what that runway is on the personal side and on the business side. It's like, what are those anticipated business overhead expenses that are either ongoing or one time as you're putting the lights on in the business? And then what is it that you have to take care of on the personal side that still has to continue to, that engine continues to go. So you're able to pay bills and invest back into the business. And I think as both of us business owners, I know as like we're starting the business, a lot of times my cash flow is actually going back into the business and going into, other places, and that it's going to pay off in the mid to longer term range. So not being fearful of making those investments is important.
For sure, for sure. And just kind of thinking about just all the expenses for personal and then also for business. I think a
Yeah.
lot of times that one thing that gets overlooked is your benefits. So when you are
Yeah.
leaving, you do now have to pay health insurance that you
Yeah.
might not have been paying for before, or you might have got it discounted. Looking at your retirement, you and mentioned it a little bit before with the SEP, and then also the 401k, solo 401ks. You may have been getting a match before, you're not getting a match now. So how much do you really need to be contributing towards your retirement account
Yeah.
to make up that difference, as well as just like your disability insurance, and if you had any life insurance or anything from the
Yeah.
previous job as well. Just kind of making sure that you're able to not only sustain the lifestyle that you already have, but then replacing benefits or things that you already had that are going to be an additional cost that you have to kind of make sure that you think about, because a lot of times we kind of forget about those because we're not paying for them if
Yeah.
you're under
Exactly.
that
And
employer.
healthcare is not, it is not, certainly it's not, yeah, it costs a lot of money for healthcare. I mean, I think just on the personal side, I do think that, and not to go on this soapbox, is that there are alternative ways to get healthcare. One thing that I've personally looked into for myself is the MediShare, and they usually can be faith-based, but for me and for what's important to me is I more have a secular, for it not to be attached to a faith-based organization. But there are ways to really help lower your get the healthcare that you need without paying such big premiums. And I think that is the biggest hold, that's the thing that holds back a lot of people, is that you're paying these ridiculous high premiums for preventative care when you can pay it out of pocket a lot less. So I do think like researching and understanding what your options are. But yeah, when we are coming from a corporate perspective, it is very easy to rely on those benefits and then kind of get shell shocked when you're paying it on your own.
For sure, for sure. And I agree 100%. There's a lot of stuff out there. It's just making sure that you're doing your research and preparing
Yeah.
for it. So just to know all those numbers isn't to deter anyone from like, no, you shouldn't start a business, but more so just know that there are resources, there are government subsidies, the
Mhm.
marketplace in California,
Yep.
cover California,
Yep.
things that you can get that will help you basically kind of replace to what you already had. So yeah, I think that's pretty much spot on.
So switching to, more personal finances, as, a question that I get all the time, or people will always ask, like, who do I need to have on my financial team? It's like, yeah, we're having this conversation, you're a financial planner. And although we can talk about tax planning, we're not CPAs, we're not accountants, we're not filing taxes. So I think it's really important to help people understand, like, who do they need to have on their financial team?
Yeah, for sure. When I think about a financial team, I think of like just like a table, kind of like a board meeting or something. When I think of some core people that you should have, one person is a CFP. So what we are, certified financial planners, and we just kind of help orchestrate everything. So making sure that everything is kind of working together and working cohesively and not in a silo. So I definitely think everyone should have a CFP. A next person is a tax professional, whether that is a CPA, an EA. On that end, that's the person who's going to handle all the taxes, making sure that you're saving money there.
What's an
Uh,
EA? For those.
yeah, yeah. So for those who don't know, EA is an enrolled agent. So that's the one who can basically do your taxes for you. They're going to really be helpful and integral on making sure that you're saving money on taxes overall, as well as the filing and the application of actually putting the taxes through. So that's going to be the EA, and then the CPA, certified public accountant. Those are the individuals who are also going to be helping you do taxes, but what they're really doing is they're more so from a strategic standpoint, where an EA typically is more so the individual who's going to be filing the taxes. They can both file, but typically a CPA is going to be a little bit more structured and have a little bit more detailed around their tax planning strategy for you. So the next person is, I would say, an estate planner. So that's someone who's going to help you with setting up your wills, your trust, making sure your advanced healthcare directive and everything is set up. So that way, if something happens financially, things are going to be passed down efficiently in the right way. So those are probably like the main three people that I would kind of recommend having as far as on your team on that. And then also just to add a few other people actually. And the next person is, I would say, an investment manager.
Yeah.
So that's going to be someone who's going to manage your stocks, your bonds, and making sure that your money can kind of grow. Another person is actually also an insurance agent. So making sure you have all the insurances that you need, whether that is your life insurance, your disability insurance, as well as a property and casualty insurance agent was going to help you with your homeowner's insurance as well as like your car insurance and insurance for your property. So those are kind of like the main five people I would say.
Yeah, and I think, and maybe, to also kind of help, break that down for people, because I know we both do estate planning for clients. We help to offer that service. Like, even though we're not lawyers, we offer that service. Is, when do you, like, whether it's the estate planner or, having an attorney, like, that you're able to, have on your team and call, or the investment manager, especially in this day and age where you can easily invest, right, with Vanguard, Fidelity, Robinhood, and Charles Schwab, like, people don't necessarily need to go to have a broker the way that they did back then. When do you feel like it's important to have that relationship versus kind of maybe trying to do it on your own?
Yeah, so I think one is around your expertise and your comfortability around it. So I know some individuals that I work with, I'm sure it's the same for you. They like doing their investments on their own and they're very astute on their investments and they're very comfortable with it. So for someone like that, maybe they don't need an investment manager. Maybe they can do it on their own. But for someone who's looking for a little bit more hands-off approach, are they just too busy? Are they have a lot of going on and they want to make sure that their investments are professionally managed? That would be someone that I would definitely recommend that they have an investment manager is when they're really busy and they need to kind of offload that off their table to make sure that things are working efficiently, or if they just don't have the information or the knowledge. So I would say like if you don't enjoy doing it, then you should probably offload it to someone else who's going to make sure that they're doing it for you so you can spend the time with the things that you like doing and spending time with your family, opposed to spending most of your time kind of managing your investments, when it's a lot easier to kind of offload that and have a professional do it, because they can do it at scale where they're managing a lot of people's investments, where if you're just managing your own, it's a lot of work for one person.
Totally. Yeah, I think I always say, like, when you're kind of graduating and, from getting to like that next level and building your home, it's always helpful to have those relationships so you're not having to, kind of try to figure out and put these pieces of the puzzle together yourself. It's just kind of start to outsource and making sure that you have the right people on your team. And I think a big one too is that, a lot of people will ask is like, if I'm in debt, whether, and we can also break down debt as, consumer debt versus either student loans and mortgage, kind of lump that all in and then kind of break that down. But like, if I'm in debt, should I pay that debt off before I invest? Or I'm sure you get that question all the time too. It's like really how to balance being in debt versus, continuing to, progress financially.
Yeah, for sure. So I feel like debt is, I always think of it like a fire, where, well, like what I call a good debt, like a student loan, or a mortgage, or a low interest type of debt. I consider it like a fire, and it's in your fireplace and keep you warm, it can keep you comfortable. It's like what I call a good debt or good fire. Well, for something like that, I wouldn't really rush to pay that off. I would keep that going, keep that fire going in your fireplace, keeping you warm, making sure that that low interest debt is helping you propel to where you need to get to. And then you're able to also invest on the side. So for something like that, a lower interest type of loan, or like mortgage student loans, I would definitely recommend investing while paying that down. So doing both. But on the other end of the spectrum, like a credit card debt, a high interest debt, something like that, I kind of consider those as kind of like a fire in your front yard, where you kind of want to put that out like ASAP. So I'd recommend putting that out and doing that before you invest, just because those high interest rates will be growing faster than most likely the money that you're making on your investments. So for that, I would always recommend like a high interest rate, paying that first before investing, versus a lower interest rate. I would definitely take your time on paying that. I wouldn't really rush to pay that off.
Yeah, and I think I just had this conversation with a client she's kind of close to paying off her mortgage, but I think it's also really important to see, instead of kind of putting all of your money, because she really wants to take a lump sum of money and put it towards, paying off her mortgage, but now it's about like looking at your tax return. Are you taking that, if you're taking a standard deduction versus itemizing, then okay, maybe that may make sense. But if you're itemizing on your tax return, you got to remember that what itemizing means is that you are writing off that mortgage interest, the power property taxes, and it means that that amount adds up more than the standard deduction. So it's going to be in your favor to keep the mortgage on your quote unquote balance sheet. So you're continuing to get that interest on your tax return.
For sure, yeah, and I think that's what we help with so much, is all those nuanced things,
Yeah.
opposed to just kind of looking at it from a one numbered basis. Sometimes I feel like people will look at things and they'll say, "Oh, like it makes sense to pay it off because this is higher than this," and
Yeah.
they don't take that third or fourth look into things and say like, "Oh, well, I will be losing out on that itemized deduction, so I'll probably end up be paying more in taxes." So a lot of people don't really look into that.
Yeah.
So I think that is something that, as a CFP, is something we do really, really well, is being able to look at all aspects of
Yeah.
everything that's going on, and making sure that, one, you're not just getting the highest return on your investments when you're comparing, or you're
Yeah.
just saving the most in interest, but we're also looking at, comparatively, if you do this, what else is going to be affected by going this route versus this route. So yeah, I think that was a really good analogy to kind of point that out, because that happens all the time with not just debt and mortgages, but just so many other things.
Yeah, it's so true. And I think, like, to your point, I think with credit cards, I mean, I think we obviously agree there. It's like it's got to get rid of those, are so high. There's such a high interest rate these days. Otherwise, it's really like when you know how to leverage debt in the right way, then debt really shouldn't be a negative word. It really should be something that is just part of your financial picture. But again, it's about leveraging it in the right way, because I think it could be actually an asset when you're leveraging it in the right way.
For sure. For sure. 100%.
And I think the other one other question that comes up often, and sometimes I know in my conversations with clients, and I'm sure you do as well, sometimes it can feel like, you're also part therapist when it comes to talking to couples and their money, and helping them make their decisions. But as someone's either, preparing to get married, and I think in this day and age, as we're getting married, a lot of people get married a little bit later on in life than maybe previous generations. So they may be coming to the table with, assets or accounts that they didn't, that they're their own, but they still think about it from a household perspective. But what are some things as someone's getting married, like either how to merge their finances or how to have that conversation and how to really go into the relationship or the marriage with a healthy money mindset together, because we all have some relationship with money too.
For sure. For sure. Yeah. I just think about like my grandparents and just how they manage money and just like it's completely different.
Yeah.
It was kind of like you just put all in one pot and then now you're married and that's it.
Yeah.
Um,
Because your
so
grandparents
there's
probably got married very young too.
Yeah, exactly. I married really young. So yeah, it's different schools of thoughts. I feel like if you ask 10 different advisors, you might get 10
Yeah.
different answers on how to manage finances as a married couple. But my personal preference is I think that you should have stuff that's together and then you should also still maintain your financial independence as well. So what I always envision that looking like is one person has their own checking, one person has their own savings, the other person has their own checkings, the other person has their own savings, and then you also have a joint checkings and a joint savings for the things that you do together. So if you're going to a trip together, that would come out of your joint checking and your joint savings because that's something that you do together. Versus if you're going on a girl's trip or a guy's trip, that would come out of your own
Yeah.
individual checking or savings because that's something that's not the togetherness of you both. So that's usually how I'd recommend doing it. And just setting up that structure is just having that conversation and talking about that. And then as you're having that conversation, starting to identify, okay, what are the things that we do together and what is the things that are in our kind of middle circle, and then figuring that out and then starting to move that into the joint checkings and then starting to contribute into the joint checking and feeding that for the things that you both want to do together, as well as still maintaining your own independence on things that you like to do just as your own individual. So that way you can still do those things and not have to worry about, oh, I'm pulling from the
Yeah.
middle ground or kind of rattling the relationship or feel like you can't do something because of the fact that it's going to affect the whole overall. So that's how I recommend. But again, if you talk to a lot of other advisors, they might recommend throw it all in the same pot. So everyone's a little bit different on that end.
Yeah, I mean, I agree with you. My school of thought is the same. It's like you keep your independence. I do see that a lot of people may have like multiple checkings and savings on the individual side, and then they open up at some point in their relationship, either prior to marriage or, as they're getting married, they have like now a joint savings. That maybe we can consolidate what you have on the personal side. Maybe we don't need all the checking and savings. We can maybe have one or two accounts, depending on like, yes, if it's where money's going into it, either from a paycheck perspective or how you're getting paid. Maybe that's just checking or savings, and then like keeping, either checking and savings jointly, making sure that the savings account is also a high yield savings account, and then just understanding like where are bills getting paid from. Because I had a conversation with a couple, that I started working with last week, and it's like he has like three different checking accounts. Like one was an account, and I can appreciate this. Is like I started my first bank account, when I went to college for a long time ago. It started out, it's Bank of America now, but it started out as Barnett Bank like 30 years ago. Like, all the consolidations that's happened, I've had that account for so long, but then I've opened up another account that has a little interest savings. And so I can understand like how he ended up having all of these like checking accounts, but he has like bills coming from this account, bills coming from that account, bills coming from that account. And it's all bill pay. I'm like, let's consolidate that this way we know what's coming from the household, what's personal, and then like let's, as much of it could be painful, is start moving those bill pays from the joint account. So this way we can just not look at like 9 different accounts.
For sure, for sure. And like I think a big portion of just financial planning is just organization and just kind of
Yeah.
having this account, this account, this account, this account, but then kind of just consolidating it into one, having a purpose for this one, and then using it that route. So yeah, I see that a lot too, where there's like a lot of different accounts going on. Just as we live life, we just accumulate stuff. So
Yeah.
just with everything, just trying to keep it simple, it will go a long, long, long way.
Yeah, and to your point, the organization I think is the biggest is really the foundational part to, I know a lot of our client conversations. I think when you're unorganized or feel like you're unorganized because you have so many different accounts, I think the feeling that even when the feeling that comes along with that, even when I know, like when we're talking to our clients and we're looking at the bigger picture, and even if we can kind of add it up, and you're like, okay, the net worth equals this, and on paper that looks fine, but it's that feeling, that intrinsic feeling that you're like, I have all these different accounts, so it's really hard for me to get agency over. Do I really feel like I'm in control? Am I really feeling like I'm putting my money to the best use? When there's always that little feeling in the background that you're like, I'm just unsure because I feel disorganized. It's kind of like going, I mean, really probably, simple analogy is like, is if you're going into one of your drawers and you're like, I know I have my shirts in here, but I can't find
Yeah.
the shirt. It's like I
Yeah.
there, but like how, if it's unorganized, it just kind of feels like I'm not organized.
For sure, for sure. Like you have the shirt, it's there, it's somewhere.
Somewhere,
When you need it, if you really need to get it, you can get it. But it's something about that peace of mind of knowing that it's in the top right drawer in the corner and
and you're not
just
gonna have to
knowing it's
iron
there.
it when you get it out of
Yeah,
the drawer.
for
Like,
sure. It's already ready to go. Just
yeah.
throw it on and keep it pushing. So yeah, that's a really great analogy.
So, yeah, well, I know that as we continue this series, is just try to get more questions and, bring up the questions that we hear from our client conversations. And then obviously want to get get the audience and have them ask additional questions as well.
For sure, for sure. Yeah, definitely. So I think that's really important to get more questions and have individuals ask questions so that way it's engaging because I know all the stuff that we talked about today is going to help so many different people. And I feel like it's the constant questions that we get asked over and over and over and over. So, as far as audience, anyone who's looking at this and they may have had a follow-up question to anything that we mentioned, please drop it in the comment section. We're happy to answer any of those questions and talk about it in our next series. So, definitely looking forward to that. Perfect. So with that being said, that was another episode of Ask the CFP. So again, if there's any other questions that any of the audience has or anyone has around finances, we're happy to answer those questions. So please drop those into the comment section and we're happy to answer any questions that you have.
Awesome.
So stop this.